Congrats, Sonia. I think Michael is a colonel now as well. So you all beat us to nominating you. Cool. Yeah. Yeah, we have some Vistas joining. Thank you all for joining. They just started on Monday, which is why I said um, they could join just if they're able to make it. So thank you, Karen, for joining us, and Silas. And Karen's a returning member. Silas is a new Vista member. Yeah, welcome. I'm glad I asked this question. These are all really awesome.
Yes.
For the recording, for any members not able to make it, Emily Patrick said she finally got the hang of HMIS. Karen made it through all the VIST requirements. Same with Silas. I know that wasn't easy. Shout out to you all, seriously. Eddie's continued the South Frankfurt food share into October. Eddie Fowler. Michelle has been pushing through a lot of stuff and staying strong, still doing good by the ladies at Fresh Start Frankfurt. James helped the client with his Social Security check that was about to be taken away. And now that client that is secured, no longer being taken away. Sonia mentioned making it through all the holiday donations. I know that's always wild. Emily Morgan, Austin Kirkland, Michael are now Kentucky Colonels, which we usually, or last year we nominated our fourth year members for that, but they've already got it. So we'll have to think of something else. Um, Michael mentioned a client didn't qualify for housing programs at first, but they gave them advice that we'll talk about today, thanks to Rebecca, about how to get into better financial standing, came back and they're eligible. So that's awesome. And we'll talk about how that was like actually done, which I'm excited for today. Awesome. Thank you all so much for sharing. I'm really glad I asked that. Um, yeah,
Okay.
if Rebecca can take over,
Yeah, I'm going to
we can
stop
go
sharing
ahead.
my screen. And Rebecca, you should be able to take over.
Okay. Okay. Can you all see my screen? Okay.
Yes, ma'am.
Awesome. Okay, so my name is Rebecca Vermillion. I am a 2-year AmeriCorps service member alumni. So I served for 2 years straight here at the Housing Development Alliance. I'm from southeastern Kentucky. I was born and raised in Hazard. I went to school all the way in West Kentucky and Murray, and then I decided the flatlands are not for me and I wanted to move back to the mountains. So I came back here and I didn't really exactly know what I was going to do, but there was a temporary position that opened up as a summer intern at HDA. I took that and then they threw me into AmeriCorps and then they hired me after that. So I am very blessed to be an employee of Housing Development Alliance. They're a great place to work. And here's a little bit of information about them. So the HDA, we are a nonprofit affordable housing developer. Those are sometimes also interchanged with a CHODO, which is a community housing development organization. Not all nonprofit housing developers are CHODOs, but all CHODOs are nonprofit affordable housing developers. Our service area, we serve in 4 counties in southeastern Kentucky, and that is Perry, Leslie, Breathitt, and Knott County. We were created in 1993 by a group of very strong Appalachian women that were working in homeless services. And they realized when working with their clients that repeatedly the biggest issue for these folks was housing, a lack or inadequate housing. So they put together a program to help connect folks to grants that first started out mostly with rentals and started as like project-based vouchers, but then they realized there were other kinds of funds through KHC that they could use for building new homes and even repairing pre-existing homes. So over that period of time, we have served about 3,000 people. We offer a variety of services. Our two biggest programs is our new home construction program and our repair program. So on average, every year we build 30 to 40 new homes. Every year, about 80 to 100 homes are repaired each year, and those are pre-existing homes that are owned by a community member. And they call us, say, hey, we need repairs. And so we can do that with grants and loans. Most of our folks use grants, but sometimes we do have loan opportunities too. And then we do have some affordable rentals. We don't really like buy or build rentals very often. Sometimes if a house comes up as a foreclosure, we may buy it and then develop it into a rental. But most of our rental opportunity are pre-existing units that we built long time ago and continue to rent them out today. Our services changed a little bit in 2022 when the flood in July of 2022 hit our service area pretty hard. There were I think there were 13 counties that were impacted, and they were FEMA declared in a state of emergency. All 4 of our counties were affected by the flood. They were all in that list of counties. So with disaster relief, we started with cleanup. So we would come into people's houses and literally shovel mud and flood debris out of their homes and just kind of get it to a point where they could like walk around in it. And again, now we're into actually helping people rebuild and repair their homes. So that's where we're at with disaster stuff right now. So since the flood, we've served probably about 130 folks, probably a little more than that. And that's a mix of building new homes and repairing pre-existing homes. So this is a little bit more of a detailed overview of what HDA does. So we've invested over $100 million back into the local economy. We've added approximately $45 million to the local tax base, which adds about $450,000 in local tax revenue. We've supported 80 local jobs. I believe this number has greatly increased because we've doubled our staff. And we also have subcontractors that we support with contracts that we sign on our construction projects too. We also have a program where we provide paid on-the-job construction training for folks in recovery. And if those folks complete that program, they will have all of the certifications they need to work for any carpentry program. We give them the on-the-job training. I believe the program is about a year, so they have like a full year's experience framing, painting, finishing houses that they can take with them anywhere. Over 70% of them, of our trainees that have completed, have gained full-time employment or are going back through school to finish a degree. So to understand why what we do is important and why what you all do is important, I think it's important to understand what housing in Kentucky looks like right now. So currently there are just shy of 2 million housing units in the state of Kentucky. And that is houses that are occupied, houses that are sitting vacant, houses that aren't livable. So this is any structure that's considered a housing unit. So over half of those are detached houses, what you think of when you think of a stick-built single house, not mobile homes. Mobile homes, though, do account for a disproportional amount of Kentucky's housing stock. So compared to the federal numbers, we have a much higher amount of mobile homes than other states, and even compared to the national average of 7.5. So we have about 12% of our housing stock is mobile homes. National average is 7.5. So, like I was saying, the one unit attached structures is a portion of that as well. These are similar to single family houses, except they're connected. And so each unit is for one person, but there's technically more than one unit in each structure. So, like townhomes, duplexes, condos. Over half of all units in Kentucky were built in 1979 or earlier, which means these houses may have been built with lead-based paint, which is 40 to 50% of the units in our area, in our service area, in all of our counties were built in 1979 or earlier. And this is our map here. This is over here. Perry is this little weird, I don't know if you guys can see my mouse. Can you see it? Maybe over here. Perry's this little yellow piece right here. This is where we're located. Leslie here, Breathitt here, and Knott County here. Yellow, we do have in Perry County a little bit more of the population, the housing stock that was built prior to 1979, and that is because Hazard is a larger town, and a lot of those counties were developed after Hazard and Perry County were developed. So a lot of the housing in Perry County is much older than the other counties because they weren't settled quite as early as Perry. So what I deal with most is called owner-occupied housing. And these are residences that are lived in and owned by the same person. So it's not a landlord that owns a house that somebody else lives in. It's the landlord's own house that they live in. They are the owner, that unit is owner-occupied. So the percentage of owner-occupied units is actually pretty high in our service area. And that is a lot to do with heirs and being able to pass property through family. And so you may have a house that was owned by a great-great-great-grandfather, and no one else has bought a house since then, but there is an owner-occupied unit in the family. So they may not have ever purchased a home, but they do own a unit, a house. So those numbers are a little bit higher on our side. If you look up like in Henderson County or like in Jefferson County, a lot less because you're going to have more rentals. You're going to have other kinds of opportunities where people have investment properties or they have vacation homes and things like that. So ownership of owner-occupied housing is passed with a deed, and that kind of basically assigns that house to someone, and it attaches that house, that person, and the loan kind of all together. So the mortgage actually secures it. That is the loan that folks take out, and the mortgage basically is protected by the value of the home. So if the clients were to not pay their house payment, that house could be repossessed and the mortgage company would take the home because that is what they've deemed to be valued at the same as what the person borrowed for. So median home value in this area is $96,750, which is not a whole lot for the value of a constructed home. The homes that we build are valued anywhere from, at the lowest, $150,000. We do build some houses that are valued a little over $200,000. Those are our highest tier houses for our more moderate income buyers. They can buy up to a larger tier, but most of our homeowners are in the 150 to 185 range. And 3 of our 4 counties are actually the 3 lowest median home values in the state of Kentucky: Leslie, Breathitt, and Knott County, with Knott County being the highest of all of those, but all of them being under $55,000. The median monthly cost to homeowners is $578 a month. So this would include your mortgage, your property taxes, your homeowner's insurance, all of those things, everything basically without utilities. So the reason why we don't help people buy houses that exist, even though there's so many of them, why don't we just help people buy houses that come for sale? There's a few reasons. One of the biggest things is there's a lower value. So if we help somebody buy a $96,000 house versus a $150,000 house, one day when those folks go to sell, they will get more from the $150,000 house than the $96,000. They'll have more equity also when they own that home. When they have a higher value home, they have more available to them to kind of loan against and to kind of improve their borrowing power. There are also a lot of title issues. Like I was saying, a lot of this owner occupied rate is attributed to the passing of property through heirs, and a lot of the times there's a lack of wills, so there's an kind of an undivided interest of all of the heirs. So I was looking at a piece of property for myself. We found the deed. We went to the deed room and we pulled the deed. Both the people had passed. And so I was talking to the person. There was no will. We found, I don't know if we found an obituary. We found something that listed the heirs. There were 14 heirs, and each of them would have to sign off on basically selling their portion, however much, 1/14th, to us. But the problem is if any of those people have died, you have to also contact all of their heirs, so on and so forth. So it can become literally exponentially difficult the further you dig into those things. So sometimes it literally is more cost effective to just build a new home. There's also a lot of issues with tax liens or unpaid property taxes in this area. You're going to come across that in any rural area or just lower income areas. That's going to happen. Property tax is expensive, especially if you don't have a mortgage that escrows your payments and you have to pay one big over $1,000 payment in one go. That can be very difficult for folks, especially on fixed incomes. And then because these homes are older, because they're less valuable, because there are other issues with them, they also usually need repairs. And so when you add all of those issues, all those costs up, usually it totals out to more than actually building a new home. And those repairs often is because we do have an aging housing stock. So we have a lot more older homes than we do new homes in this area. So what I do and my department does is we are the developers, so we build these houses, but we also act as sort of the client liaison between the lenders that they choose and the grants that we help to put together a financing package to help subsidize that payment for them. As such, we do a lot of work with folks before they apply for mortgages to help them get ready for that process. And so that's called housing counseling. There are different kinds of housing counseling. HDA does not do HUD housing counseling, which is a whole other animal. That's what this slide is about. And that's pretty much all I'm going to talk about. It is that it's much more detailed. There are some requirements in terms of how to talk with clients, documents you have to have in files, and then there's also different parts of counseling that you would have to include. So HDA is working on becoming HUD certified so that we can provide HUD certified counseling to all of our clients. But it's a long process, so we are working through that. But it is more detailed. You can do a lot with folks without going through a full HUD counseling program. All of our homeowner clients do go through a HUD counseling education class, but they do a lot of their counseling that really makes or breaks their case well before they even apply for a mortgage loan. So they're going to do mostly this top bullet. This is what I do a lot with her clients, is pre-purchase home buying and home ownership counseling. So there are some other kinds of counseling that comes with being a HUD certified counselor, helping prevent and resolve default and foreclosure, financial management for current homeowners, rental topics, as well as a lot of homeless service assistances as well. So emergency shelters, transitional housing resources, those kinds of things. So long-term, HDA will be doing that, but we are not doing all of those things yet. So home ownership and home buying counseling is a kind of housing counseling, and HUD says it must address at least these following topics. While we are not HUD certified, the counseling that we do, I try to make sure I cover all the topics within that. So I do adhere to this part, even though we're not HUD certified and have to send HUD certified education materials to folks. I still like to be pretty comprehensive when talking to folks. So help them decide whether they want to buy a home, help them understand selecting a home and the purchase of the home, what that process looks like, help them understand a home inspection process, why that's important, what that looks like. If there are issues that arise during, before, or after the purchase process, we deal with those. We also help them understand selling and disposing the home. So if, 15 years from now they need to sell, they know, they have a basic understanding of how to do so. But they also have us as that connection to come back to. So to receive HUD funding or use HUD programs, you do have to complete that home buyer education course. So we send our clients out that use HUD funding and HUD programs to it's called eHome America is what it's called. And it is a HUD certified online counseling course. It does have a paid component, but there is also a free counseling service through, I think it's through Fannie Mae and Freddie Mac. And they've got, I don't know what the actual program is called, but if you go to, if you look up Fannie Mae, Freddie Mac housing counseling, it should pop up. So, the counseling, like I said, is not HUD counseling, but we do try to have, somewhat of an idea of what each person's, we do a lot more tailoring counseling than HUD counselors do. We tailor a lot more of our information to the client. So it really depends on what my client's issues are. Like, for instance, I have a client, she's owned a home before. She has an 800 credit score. She's bringing $80,000 to the table to buy this house. She probably doesn't need to know about how to use a credit card. We go over it very briefly. Here's good practice. Keep doing what you're doing. But we may discuss maybe more in-depth HELOCs, home equity lines of credit, or escrow, or those kinds of things. So it really depends on the client and what their issues are, how we address that. So the first step for our folks is choosing if they want to own. Do you actually want to own? Is that actually what's best for you right now? So the best thing to do is kind of create a pros cons list with your client. What is your goal? Some advantages of owning: you build equity. So the more you pay into that home, the less you owe on it, and therefore you have money available to you to kind of borrow with your home. You also have a lot more stability. You don't have to worry about your landlord selling your house and then saying, oh, well, I'm not your landlord anymore, and the next person doesn't want tenants. You don't have to worry about that. You also are going to be investing in your community. Paying your property taxes and being in a community can be very fulfilling for some folks. There's not going to be lifestyle restrictions. So I tell my clients, when you close on that home, if you want to rip out every wall, baby, you do it, because it's your home. If you want to plant a tree right next to your house, probably not a good idea, but it's up to you. And so there's a lot of folks that come to me for that reason. They're like, I want to be able to put a pool in for my kids, those kinds of things. You're not going to be dependent on landlords for maintenance. So if your heater goes out and your landlord already spent your rent for that month, and he's like, well, I can't fix it until 2 months from now. If you've got the money saved, you can get it fixed that day. So you do have a lot more freedom to kind of repair and work on your home. Some disadvantages: you have very limited mobility. Selling a home is a lot harder than ending a lease. Very hard. You are also responsible for property taxes. That's something your landlord would be paying for you. But when you no longer have the landlord, that comes down to the owner of the home. You also are going to be liable. There will be legal liabilities with you owning a home. Somebody gets hurt on your property, they could sue you. Previously, they would sue your landlord, but now that's you. And while it is an advantage that you would not be dependent for maintenance, it can also be a disadvantage that the maintenance would be on you. So if your roof blows off, that's your roof, unfortunately, and that is your responsibility. So, but for renting, there are also advantages and disadvantages to renting as well. Some advantages with renting, there is more mobility. If you need to leave, you may even be able to find somebody that can do a month-to-month lease for you or a short-term lease. You're not going to be able to do that when buying a house. There's much lower upfront costs. There's no down payment. There's no escrow fees. There's no earnest money. There's no, you may spend $50,000, $60,000 in upfront cost to buy a house, whereas for renting, you may spend three, first, last, and your security deposit, 3, 4, 5,000. But it's going to be much more when purchasing. There's also little or no maintenance responsibility, assuming your landlord does the maintenance they're supposed to. You're not responsible for insurance and property taxes, so you don't have to worry about those two big costs. You don't get to build equity in a rental. You're not paying into your rental. Every time you pay rent, that doesn't build your financial well-being in any way. The only way it could affect your financial well-being is if you did not pay rent or you had it reported to the credit bureaus by choice, but you would have to choose to do that. You don't have any control over the costs. That can somewhat be a bit of a disadvantage with owning. If you have an adjustable mortgage, if your interest rate is subject to change, that could be similar with owning. But many first-time homeowners are going to get a fixed rate. And especially if you're looking through like the government or some of the loans we'll talk about a little bit later. You're going to have lifestyle restrictions. So you can't hang things in the window. You can't smoke. You can't have pets. You can't, all of those things you don't have to worry about as an owner, but as a renter, you do have to consider that. And there's no security of permanence. Your landlord could sell your home today. I can't count the number of people that come to HDA because they know their landlord is selling and that the next person does not want tenants. So one of the first things, once we determine, okay, this client, this is what they want, this is what they are ready for, our next step is to determine what can you afford. So there are a couple of things that we look at first, and that is their income and their debts. Michael will actually collect this information from our clients. He will collect their income and debt information and do a very brief eligibility review, and then he will recommend them to move forward in the process if they fit those limits. So he will use their gross income as well, the lenders. That's why we use gross. Our clients sometimes question us on why we use gross. I say we use gross because your lender will, and we want to make sure you understand what the lender is going to show you. We want to know, has the client had stable income for the last 2 years? The lender's going to ask. They want to know, if this is the first job they've ever had, how do I as a lender know you can handle a 30-year obligation and you've not been employed for 2 years? So they like to see at least a stable source, or they like to see documentation. So if I have clients that have babies, I have clients that get injured, that's understandable. I have clients that take different jobs and they stay at different places. They may float to different companies. That's okay. We just have to kind of understand what that situation is. But most likely, folks who have been through our process usually have a pretty stable source of income. And you want to also consider, when Michael is looking at their income, there are incomes we cannot use. And so when they're talking with Michael, talking about doing an intake, we have to consider, okay, you're telling me you make $2,000 a month, but your AmeriCorps stipend we can't use that for your loan. So that is something to consider. And that's something to counsel your clients on too, that it's okay because homeownership takes a while anyways. Let this be a moment for you to get your education award. Let this be a moment for you to save a little bit more. That's okay. Is there temporary income? If somebody gets child support for a 16-year-old, I'm probably not going to fill out their their loan application with including that child support income, because it's very likely it could end if the client knows if there's some way that it doesn't, that they know it will not. Like if it's arrearages or back pay, that's different. But if they have a child in the home that's 16, they're getting SSI. We're not sure if that child will continue to receive that SSI. We're not sure if that child will continue to receive child support. It's best not to count it when considering their affordability, because we don't want to get them in a position where we say, okay, yeah, you can afford this because your income is this high, but then they lose that income and we say, oh, actually, now your income's too low. You can't afford that. And then you want to consider also special purpose income. So does the household receive a stipend for like an adoption stipend? Do they receive SNAP? Do they receive an AmeriCorps stipend? Those things can be excluded or included. Not AmeriCorps, but things like AmeriCorps SNAP, KTAB, the state supplement that folks get, the CIS check. Those things are special purpose incomes. Some of them are not allowed to be counted, but some you can request to be counted. So SNAP, for instance, you can count it. You don't have to. And does your household qualify for any income deductions? This is going to depend on the lender or your grants. And this will typically apply to like within the income limit. So for the USDA rural development loans, minor children count as a deduction of $480 to the annual household income. So we can take that from their income, and if it puts them within the income limit, then that is a qualifying deduction. Sometimes we cannot get enough qualifying deductions to get them within the income limits, but I haven't had to do a whole lot of this, honestly. And then I also, whenever they kind of get past that initial review, whenever we're a little bit further in looking at their income, when they're talking to me or when they're talking to our specialist, we may also get a copy of their tax returns. And that way we can look at a comparison of the last 2 years and then the pay stubs I'm looking at now or the benefit award letters and kind of see how that trends. Is this explainable by just a cost of living raise? Do I feel like there was more? Do I feel like there was a second job reported in last year's taxes? So the taxes can be a really, really, really nice thing to have when looking at income. The other thing Michael will ask about is their debts. So with debts, there are kind of two different kinds of ratios. You can look at the housing ratio, which is your expected house payment divided by your income. And then your debt load is going to be all your monthly debt obligations divided by your income. And then you'll have a total debt ratio. And that's the first part, the housing part, all your other debts divided by your income. And so each lender will have different ratio maximums that you can come up to. And so we, as an organization, try to make sure our financing makes it as comfortable as possible for our folks to try to keep them away from the very maximum. But sometimes that's how that works. Government lenders, they all have varied debt ratio limits. Typically, they're a little bit more strict debt ratio limits because they are not a traditional lender. So they're not going to be basing how much you can lend on your credit and your credit worthiness. They do look at your credit, but really it's about mostly your income. So those ratio limits are usually a little bit more stringent because you're a little bit lower income with those loans. And debts also are not just loans and credit cards. I think a lot of people think that, oh, well, I know they do because Michael will ask them, do you have any debts? And they'll list loans, credit cards, all those kinds of things. But alimony, child support payments are debt obligations as well. Judgments, collection, payment agreements, those things are debts. If they have a Chapter 13 bankruptcy that they're actively paying on, that's a debt. Oftentimes folks don't consider those things in the same world as debts. So sometimes we discover that later in the process, but they are there. There are two main kinds of actual credit accounts when you're thinking about types of debt. There's revolving accounts, which are typically credit cards, charge accounts. These are things you charge, and your monthly payment varies based on what's in your account. So if you have a $300 balance, your monthly payment is going to be very different from somebody who has a $100 balance on their credit card. And you are going to have a different payment next month if your balance is only 100 versus 300. Installment accounts, though, however, are credit accounts that have set terms and payments. So these are like car loans, mortgages. They say, okay, you're borrowing $8,000. You're going to pay us $200 a month for 48 months. And that is an installment account. It comes in installments, whereas the revolving, you can kind of use it and not use it, use it and not use it. And your payments depend on your usage of it. So when we're talking about all of these things and we kind of determine where their income's at and their debt's at, if their debt's a little high or if they're having issues with saving, our next big step is to talk about budgeting. So when I sit down with my clients and talk about budgeting, I tell them you want to consider all the money in your household. So not just the money that we're going to use with the loan, but if you have child support payments, if you have adoption assistance payments, if you make a little bit of money selling stuff on eBay, we're going to consider all of that money in your household because every single dollar is going to make a difference. You want first to get an idea of what you're currently spending. You want to know, are you currently spending money on grocery, clothing, transportation, etc.? Like, give us a good estimate. That's where we'll start. I like to have my clients use bank statements if they use their cards. If they take cash out, which I have a lot of clients that will buy, they'll go get cash and then they'll pay for everything in cash, or keep a written record of all expenses. So either bank statements or a written record of all expenses. And I tell them, even if it's a McDonald's sweet tea, $1.36, you need to write it down. And do not change your spending habits. I always like to tell my clients, let's take an honest look here. Let's do this first just to see where you're at, and then we can come back and readdress it and change your budget if you feel like you need to. I can give them suggestions, but ultimately all of these decisions are up to the client. As I tell Michael all the time, you can lead the horse to water, but you cannot make it drink. So once we have a good idea of what their current expenses are, we want to also consider any expected expenses. So your new mortgage payment and the fact that you're going to pay property tax and insurance with that. You're going to need to start a savings account and actually have a savings plan from this point forward if you're going to be a homeowner to cover maintenance and things like that, maintenance and repairs. So then we'll readdress the budget then after we know exactly what they're spending now. If they have any extra money, we can kind of allocate that to expected expenses. If they don't have extra money, we need to go back to step one and reconsider our budget and try and move some things around. So I always tell folks you want to account for expected costs and also unexpected costs. Your car may go out the same day you close on your house. Unfortunately, that's just the way it is. And you have to be prepared for that. You may lose a hot water heater and your HVAC all at once. You have to be prepared for those things. And you don't want to have to take that out on a loan and burden yourself further with debt if you can. If you can save and have the money saved, pay yourself back as opposed to a lender, a credit card company, or bank. So plan for larger purchases. If you know you need to buy a car in the next 5 years, figure out what the cost of that is, divide it by 5, and then divide that by 12. That'll tell you exactly how much you need to save each month based on your goal purchase and your goal timeline. So yeah, start saving now to create an emergency fund. I tell my clients, I say 6 months, but I know that's not feasible for everybody to save 6 months of their income. 3 months for sure, at least 3 months. I say 6, but that's just, I'm extra cautious. And then, like I said, for your larger expenses, set a target amount and a time frame, and then figure it out from there. If you realize, oh, I can't buy this Camaro in 2 years because I can't save that much money every month, you might want to consider a different car. Yeah, for example, I want to save up a down payment of $15,000 to buy a car in 3 years. So to do that, I would need to save about $416 a month. So banks, when we're talking about mortgages, even though you're going to buy this house through the bank, they're not going to give you all the money you need to buy this house, which is called loan to value. So the percent of loan they will give you of the value of the home will never equal 100%. So how do we fill the gap? There are programs and nonprofits that have abilities to match you with grant funding to help subsidize those loans. Basically decreases the amount you need to borrow. So say we have a $150,000 house. Our homeowners, if they qualify for the fund, will get $40,000 in forgivable grant. So as long as they live in the home for, I think it's 15 years, they don't have to repay that. They'll get another $10,000 for a grant that's never to be repaid. That's $50,000 right there. So now my client only needs to borrow about $100,000. If I can get my client other down payment assistance programs, other grants, that will cut down that amount even more. The other option is to start saving for a down payment to fill that loan to value gap. The other thing to consider in this area in particular is the cost to build a home is much more than it is actually that it's actually valued at. So for that $150,000 home I was referring to earlier, that may cost HDA $200,000 to build. So the client, we don't want that $50,000 to fall on the client. So we use our grants and development subsidy to cover that cost for the client. So they never see that extra cost. Only number they ever see is the $150,000, and the rest of that is covered kind of in the back end. So you can save. Our clients typically do not have the financial ability to save that much money for a down payment, and many of them, or those that are on disability, cannot save beyond $2,000 and have that amount of asset in their name anyway. So we do a lot of looking for programs for down payment assistance. We use Kentucky Housing Corporation funds as the forgivable mortgage, and then we use some grants through Federal Home Loan Bank of Cincinnati for our grant. So this is a budget that I'll give to clients. This helps them understand where they're at now and can help them understand also where they can go. So this down here will auto-populate for them. I type in all their information. It'll auto-populate. And if there's income remaining, I can show this client, hey, this is what you're doing right now. You actually have money left over right now, theoretically. If you want to have more money left over, let's see if there's any of these sections that you could decrease. Do you really want to spend that much money on on eating out? Do you really want to save that much money on TV or spend that much money on TV? There might be ways to decrease that. But you also want, folks are people and they want to live, So I always tell folks there are things that are non-negotiables. If getting your nails done once a month is non-negotiable, that's a non-negotiable. We'll find something else. Maybe you're okay with cutting back on your grocery expense, but that's up to the client. That's up to you. So the very last aspect of determining preliminary eligibility is credit, and looking at their credit scores, looking at their credit reports, those kinds of things. So credit scores, the actual score itself, is not going to be what makes the decision for you as a applicant. Most of the time, lenders are going to look at your score because it does give you a snapshot of what's on your report without actually looking into it. But there are times where things happen. You've had, maybe something happened a long time ago and your credit score still hasn't really recovered because you haven't gotten new credit. That doesn't necessarily mean you won't qualify for a loan. So we do look at the credit score, but I tell my clients, really, don't worry about your score. Let's worry about what's in your report and the practices, and your score will follow. So traditional lenders, banks, they're going to have much more stringent credit requirements. Like they may not even look at a credit report if they have a collection on it that has over $1,000. They may not even look. They may just immediate no. It just depends. And each lender will have different requirements, and some may even have certain preferences too. And also, you may qualify, but you may qualify for less loan, or you may qualify at a much higher interest rate than other borrowers. So, what makes a credit score? There's a lot of things, actually. Your payment history is the number one thing. If you miss one payment on a credit related account, so if you have a credit card, loan, anything like that, you miss one payment, your credit score can drop up to 100 points in one payment. That is the most important thing. I tell my clients, I swear, if you learn nothing else from me, if you hear nothing else, hear me now. Pay everything on time, or close it, sell it, whatever. Pay it on time. You have to. You have to. Your capacity and utilization is kind of one thing. How much of your credit are you using? If you have a credit card that has a $10,000 limit and you have $8,000 loaded onto that credit card, you've only got $2,000 left. You've utilized 80% of your credit. And lenders, that can make them a little nervous because they say, okay, well, if you get more loan, how do I know you're not just going to continue to take more and more and more, and now you can't afford to pay the obligations you do have? So that can make lenders a little nervous. Of course, I have clients that'll charge the crap out of their credit card and they'll pay it off every month. That's all right. It's not ideal because it will affect your score, but ultimately they're making their payment every month and their credit score reflects that. The other thing is the age and of your credit history. So younger folks often either don't have a score at all or may have a lower looking score. And that is because there's not really anything for the credit bureaus to look at and say, oh yeah, we think you're a good payer. If you've only had a credit card for 4 months, they can't say whether or not you pay well, because anybody can pay for 4 months. Not everybody can pay for 20 years. So how long you've had credit is also a big factor. And then the kind of credit you've had too. An auto loan, like if you're looking to buy a car, if they don't see any auto loans in your history at all, that might be a little bit nerve-wracking to them, that all you've ever had is credit cards. You may never even use your credit card, so you're not used to having a monthly payment. You've never had an installment account that has the same monthly payment every month, no matter if you want to pay it or not. Like a credit card, you just may not charge it if you can't spend some extra money. Loans don't work that way. So it can make lenders a little squirrely if you've never had an installment loan. And then new credit. When you open a new account, that will immediately drop your score. As long as you take care of it, typically it will bounce back up within 4 or 5 months, especially if you have a loan, because technically the amount that you owe is much higher than what you paid into it. And so it looks like the utilization is really high on new loans because you owe the full amount that you took out. And so the more you pay on a loan, your score will continue to go up. The moment you close it, it'll go back down, and then it should go back up. So when you apply for a mortgage, they will use what's called a tri-merge credit report, which will give them a copy of all 3 of your big bureau reports, your TransUnion, Experian, and Equifax. So they will look at all 3 of those. So credit requirements, like I was saying, they do vary from lender to lender. And there are, however, even amongst the credit bureaus, there are different ways to create a credit score. So there are 2 main scoring models, the FICO score and the Vantage score. And basically they just have different percentages for each of these items that make up the scores for those models. So sometimes I'll have clients that they look at Credit Karma and their score is a 680, and then we pull it and it's a 630. And they're like, oh my gosh, I don't understand. They're just calculating it differently. It doesn't mean anything necessarily. It just is a different number spit out based on the same metrics. So here's kind of the differences in those. Your Vantage score is over here on the left, and your FICO score is over here on the right. So with credit, you also want more on like what is in their report is their management and utilization. This is the really big piece that a lot of our clients will struggle with. I think on this last slide, I said 1 in 10 people that inquire with us here at HDA will actually make it past the credit process. So about 1 in 10. So you should be regularly reviewing your credit reports. If you are not, you should do that. You can do that free. You can pull all 3 of the big bureaus. I believe now it is more often than once a year. I think it might even be once a month. If not, it's definitely not just once a year. But you can get on free annual credit reports. I can send that to Valerie and Holly. And that way, because it's free, I mean, you all just type in your information. You don't get a score. You cannot pull a score. You can pay and add a score to it. I always tell my clients, remember, your credit score is not important. Don't worry about your credit score. Worry about what's on the report, what kind of payment history and things like that. That's what you really need to be watching. So some things to consider when you're managing your credit, utilizing your credit. Keep your credit cards paid off. I know almost all my clients will carry a balance, which if they make their payments, that's okay. But to have a better score and to look better to lenders, if you can pay that off every month, that is ideal. It's also ideal for the consumer because you won't pay interest. So if you never carry a balance on your credit card, you will never pay interest on it. Never. So something to consider. If you feel like, and once you get to that point where you've got a balance and you're not paying enough of it off because the interest is so high, a lot of folks will get stuck in this perpetual state of paying the minimum payment and never really making a dent in the actual balance that they owe. So I always tell people, if you do have credit debt, credit card debt, be very aggressive with it and pay much more than the minimum payment. You will get it paid off. Do not look at the letters that they send you, the little account summaries, because it'll say if you pay the minimum payment, you will have this debt paid off by $2,099. Don't look at those because that will discourage you. You can do it. You just might have to make some sacrifices. As Zach and I say, my husband, sometimes we have to go on the ramen diet, but that's okay because sometimes we need to save a little extra money or buy something special, and we're okay with, there are ways that you can cut certain areas and kind of pay a little bit more, even if it's $1 more than your minimum payment. That will get you there quicker than paying the minimum payment. Never charge more than 30% of your credit card limit. So if your credit card limit is $10,000, do not charge more than $3,000 to it. That is part of your credit utilization and capacity. So the more of that you take up, the scarier that is to lenders that, oh, she has $10,000 available and she's eating every single dollar of that up every month. That can be a little nerve-wracking. Do not pay for large purchases with credit cards. I always tell people, when you have a credit card, if you can, now, like I said, I know people get into situations, things happen, life happens. That's different. On day-to-day living, do not ever buy something on a credit card you couldn't buy in cash that same day. Do not buy credit cards as a way to make payments long-term on something large. It's not worth it because the interest is so high. It is always worth it. If you want to, you put it on your credit card, because there are things that I will do for that. So like buying a plane ticket or something, I like to put that on my credit card, but I will always make sure I can literally pay that day. If that balance, as soon as that balance hits, I'm going to pay it. So do not put any sort of large purchase on a credit card. Just not worth it. Store cards. So if you go into JCPenney's and they're like, hey, you want a store card? It'll get you 20% off. It is never worth it. It's never worth it. The rates are too high. And also, when you're talking about credit cards, getting store credit, the rewards are not very high. You can go get something from Capital One and get like a shopping related card and get so many more benefits. So if you're looking for like a good cashback card, don't go with a store card. They are not worth it. It's just another ploy for the store to make a little bit more money. It's really not worth it for the consumer. And do not continually apply for or take out credit cards, loans, whatever. Like I said, things happen. Your car craps the bed, and you also have to buy a house in the same month. It is what it is. But if it's a regular thing, I see people that they'll inquire with credit cards every other month. That will decrease your score. It will affect it. And if possible, stay away from consumer finance companies. They have very high interest rates. I've seen interest rates over 50%. Payday lenders, same deal. Absolutely ridiculous interest rates. Yet again, I know stuff happens. Some people, payday lenders work great for. It fills their need right like that. But unfortunately, these companies are often predatory towards their consumers and will try to continually keep a loan open with them to make more money. And therefore, the client really doesn't ever make enough impact in their principal to see a big difference, and they can get very discouraged. And I see a lot of folks end up with collections because of this, and they're just more predatory than a traditional company. If you can try to avoid those. And there are sometimes organizations called CDFIs. That's a community development financial institution. And a lot of those organizations were created to kind of help people find an alternative to a payday lender. So like Redbud here, HDA created Redbud, another organization, and they do credit counseling, but they also do small consumer loans. So they were created really at first to help people get out from under these payday lenders, consumer finance company loans, and rent-to-own companies like Rent-A-Center and all those. And since then, they've kind of changed a little bit about what they do, but they still do those things. So some questions that I will ask my client to better understand what I'm looking at when I see these things. Do you have accounts and you're not using them? Because if you have credit cards and you're not using your credit cards, it's not going to give you a score. Even though it's technically going to report as paid as agreed for the entire time you've had it, you've never charged anything to it. So they can't really say what kind of payer you would be on a credit account. And I have seen this happen. I have a client that she had a credit card, and it's a credit building credit card. It's a good card. And she had it for like 6 months. And I was like, girl, where's your score at? She was like, I don't know. It was like a 600 at first. Now it's like a 620. And it 100 because she didn't have anything negative. It should have just gone up. And I was like, girl, it's not gone up enough. We found out she wasn't using it. I was like, honey, you have to use it. You have to charge it, to get it to react. But she was nervous, I understand that. But I think I've convinced her to just buy a little McDonald's Coke on it every month. And that's what I tell people. It doesn't have to be anything crazy. Just put, like, I'll go through McDonald's. I'll buy, my coffee in the mornings with my credit card, or I'll buy, groceries, maybe something I know, fill my car up with gas, something I know I'm going to buy anyways. And then I'll also like to ask, are any of the accounts that you have right now, does anybody else have a name on that account? Because if so, maybe we can get it out of your name. Maybe we can get it signed out of your name and into the other person's name. Did you co-sign for somebody else, or do you have a co-signer? So those are both things that I will ask, and that happens a lot around here. Folks will use their parents or their significant others to sign on a car for them because they can't qualify for enough money on their own, and then it can get both people in trouble when that loan goes bad. But if my client's really low income and they have a car loan for their daughter and it's a really nice car and it's a decent payment, on her report, that looks, her credit, her debt load is very high. And so my question to that client is, let's try and, if this is your daughter's car, let's get this into just your daughter's name. So this isn't your problem anymore. So with credit, things that I'm looking for that are considered negative items. And this would be for anyone. If you're considering for yourself, if you're considering for clients, things that I ask myself as the client, things I look for in the credit report. Do they have later missed payments? They need to catch up any open or active accounts. So even if it's not a collection, if it's something that, I was just late on the car loan this month, like I still haven't paid it, but it was due on the 3rd, Well, we need to pay it. So even though the car loan people haven't told you they're going to take your car back, we still need to pay it because they're reporting it to the credit bureaus. And then there are derogatory accounts as well, which are things like collections, charge-offs, repossessions. These are basically things that the collection agency has either a charge-off, they say, we know we're not going to get our money. We're basically writing this off our books as a loss. And they close the account, essentially. Collections, they say, you know what, I do want my money, actually. And they sell it to somebody else. So you don't owe them anymore, but now you owe a collection company. So that's what a collection is. And then repossessions are like with vehicles, you don't pay your vehicle loan. They come and take your car. You took out a loan for $12,000. The car is worth $12,000. So now you don't owe anything, theoretically, in a good car situation. And then I also will look for the major things. Bankruptcies and foreclosures are the two big things. So Chapter 7s, you want to look within the last 3 years. Chapter 13, I just kind of want to look and see like where they're at with that. Are they in a payment plan still? Have they completed it? Has it been paid entirely as agreed? And then have they foreclosed on a home within the last 3 years? So this was an actual client I had. This is a case study. I'm going to go ahead and pull it all up. Okay, so this client, they had a few open credit cards. They were all open for over a year, so they had had time to impact the score. None of them have balances at all at that time of the inquiry, and none of them have a history of late payments. So they've all been paid perfectly on time. They're all currently paid. They don't have a balance, and they've been open for at least a year. They've been employed with the same place for 4 years. They did get, this client was separated in 2019 and then divorced the year after that. And in that time, the client defaulted on accounts because the ex-spouse was the only income source. The client then filed a Chapter 7 bankruptcy. It was discharged. So it's not 3 years past, but the bankruptcy has been discharged. So with Chapter 7s, we like to see 3 years past. This one was not yet. We don't know for sure, but it is likely that when he got that job, the creditors said, oh, you have income now, so now we are going to try and pursue collecting these debts from you. And so they called him and said, hey, you've got debts with me, and then another place calls, you've got $10,000 here, you got $5,000 here, and then all of a sudden you've got 4 or 5 different kinds of debt that's over $10,000 they're asking for. And that's when folks file bankruptcy. In this case, this client was applying for a mortgage through the federal government, through RD, and this bankruptcy is a significant delinquency. So this is a major issue, and it will require an exemption. So there are many kinds of exemptions we can request, and these 3 right here, A, B, and C, are all 3 exemptions that are legitimate. But which of these 3 do you all think would be the best exemption to request on this client? I'm reading some of the comments too. Yes, the credit cards are high on interest rates, and Rent-A-Centers are also very high on their interest rates. Buy here, pay here, that's a good point. I hadn't put that in here. There are some places where, like especially car places, there's not even a formal loan. You buy the car from that person and they form a written agreement with you to pay them once a week, every 2 weeks, once a month, what have you. And there, like I said, it's not really a loan. You could end up with a collection if you did not address it properly. But I would never suggest my clients to do a buy here, pay here. You want the auto loan because it protects you and the seller as well. So on this one, the answer would be A, because this client's situation was out of his control. He had lost the only source of income in the home, and as such did not have the ability to pay the creditors. This particular client had a child as well, and so the child and himself were the new household. The spouse had left, and so him and the child were in the house, and he didn't have income, so he had to decide whether he was going to pay bills for him and his kid, or he was going to pay his creditors, and he decided to pay his bills. Like I said, life happens, and that's okay. So there are four different main kinds of mortgages. There are traditional mortgages. So these are mortgages offered through banks, for-profit lenders, usually more stringent, often will require a down payment. And that will all vary based on your standing as a borrower. Government-backed loans, you're going to have a much lower interest rate. Interest rates as low as 1%. But it's a federal government loan, so there are underwriting guidelines, and they're set by the government. They are insured by the government, so if you default, you do not owe a bank, you owe the federal government. And there is also a subsidy repayment recapture at the end. If they were to sell their home or move from their home, they would need to pay a portion of that back. And then there are below market rate mortgages. So these are for folks that these are often offered through like nonprofit agencies. So those of you that know Just Choice Lending through FAHI, they offer some below market rate mortgages through themselves as they're a mortgage lender. Sometimes these can also be government-backed mortgages, like the rural development loans. They can also, like I said, though, be offered by private and nonprofit organizations. And then there are high-cost mortgages, and these are traditionally, they can be predatory, not always are there, but all predatory mortgages are high cost. So these mortgages are going to have, they may have prepayment penalties, so you can't pay the loan off early. You can't pay over certain amounts, not all, but some. And these are the mortgages that would have those if they had it. There are protections for these mortgages under the Home Ownership and Equity Protections Act. And that is important to know when considering getting a high cost mortgage. There are four kinds of government-backed loans. Federal Housing Administration loans. This is what a lot of first-time homeowners will get as their first-time mortgage loan. There's a 3.5% purchase price is required for the down payment. There is still private mortgage insurance that's required, a little bit more stringent debt and housing ratios, but still keeping that 31% housing ratio to make sure that their housing is affordable, as affordable housing is 30% of your monthly income or lower. VA loans are another form of government-backed mortgages, only available to veterans. They do not, I don't know if I've read that it does not include active service members, but I was looking into it recently. I think it might actually. There is no down payment required, but there may be some closing costs. It depends. And the housing ratio and total debt ratio are the same on the back end. So if your house payment is going to be 41%, you can have $0 in debt. But you can have higher debt if your payment is under 30. And then USDA loans. This is what we apply with a lot of our clients with. Number one, because honestly, we don't have a lot of veterans buyers. I have one right now, and I'm very excited because I'm going to try and apply with a VA loan with him. I've never done a VA loan application, so I'm excited for that. But usually we go through USDA rural development. They have a 1% interest rate. Their housing ratios are a little bit more workable. The housing ratio is under 30%, which HDA really prefers. They serve rural areas, and they also do not require any sort of down payment at all. There's no down payment requirement at all. And if you don't put a down payment, there is no private mortgage insurance with these loans. So here's just some mortgage vocabulary. These are things that my clients may ask me questions about things that may be, and these are going to be in documents that my clients receive throughout the purchase process. So these are just kind of just some basic terms that apply to buying. I'm not going to go over all these, but just different parts of that process. All right, so that is all I've got. There's my information. So feel free to email me or call me anytime.
Thank you so much, Rebecca. I know this is helpful, not just housing counseling with clients, but personally as well. So I know it's so appreciated. Um, yeah. If anybody has any other questions, drop it in the chat. Um, you had shared resources with me, Rebecca, from orientation. So I still have those and I'll share those again in like a recap of this email. It was a lot of information, so a recording will be sent out. You can watch it whenever you want. I assume desktop MC, is that Michael or Whitney? Anyways,
I think that's probably Whitney.
okay, gotcha. Let's see. I'm going to hold on. Trying to figure out how to reclaim the host. I have a few program updates. Um,
Hey, Val,
uh-huh.
you should just be able to share your screen. I changed the sharing settings so anybody can share.
Boom. Okay.
I might have to
Nice.
stop
Thank you.
sharing.
Nope,
But
you're
I
good,
know,
Rebecca.
yeah, no worries.
Okay.
Can y'all see my screen now?
Yep.
Okay. Well,
All right.
Thank you
and
so
I
much,
know,
Rebecca.
Thank you
thank
all.
you. Thank you
Bye.
so much. And we've gone over an hour, so I get if y'all only allotted an hour to come here, like feel free to do what you got to do, and you can always watch the recording later. I'll have this information in the recap email as well. But this is our agenda. Just going to quickly go over what's coming up. We have MLK Day on Monday. K Count is at the end of this month. Tax forms will be going out. I'm going to be sending mid-year evaluations for members soon, and then just some opportunities and general reminders. So yeah, MLK Day is a day on. It's a day of service nationally for all AmeriCorps members throughout the United States. So plan to serve for that day. It doesn't necessarily have to be for the entire day. We'll be doing our project in Frankfurt. It'll probably be like over around noon. So yeah, I'll be sending out a survey about what project you did, and that should be completed by the end of the month. Please take pictures and share them with me wearing your AmeriCorps gear to show what you have going on. If you need help trying to find a project, you can reach out to me. We can try to brainstorm together, figure out what's going on near you. Usually there are some community events with day, but it's also inauguration day, so kind of funky. But yeah, we can talk about it if you're not sure.
Hey, Val, can I add
Yeah,
something to MLK Day?
yeah, go ahead.
I was gonna say, I know that there's a chance of snow again, as if we need any more. But if for some reason something happens and your project, was planned or your day of service was planned for Monday, we would like for you to reschedule it for another day so that you can still do that. So if you are going to be serving somewhere else, like at a different organization or volunteering at a different organization or something like that, please connect with your point of contact there, and just let them know, if the weather's too bad for you to commute there or whatever the case may be, to please reschedule that within a couple of weeks after MLK Day.
Yeah, I know last year we had a big storm before MLK Day, and we had planned to have like everybody come to Frankfurt, and that was obviously like did not go to plan, which is why we're doing this more independently this year for you all to find your service projects. But hiccups happen. We understand the weather's been nuts. So yeah, don't just let me know. Like hey, this was canceled, but I'm gonna try to figure out to do this project some other time. And again, we can talk about it, brainstorm, all of that. And feel free to drop any questions in the chat. Oh, I'm so sorry. I had to pause. Holly, can you talk there's our cats fighting outside.
Oh, yes, no problem. W-2 forms. So I sent out an email to everyone last week about your W-2 forms. So if you think back to the enrollment packet that you completed, most of you guys completed that electronically through Signwell. At the end of that packet, there was a consent form stating that HHCK will send you your W-2 tax form digitally. So you guys will be getting that. It will come from Wendy, like pay stubs. I sent out that email stating, what the subject line will be. If I had to assume, it'll be like in years past, you will use the last four digits of your social security number like you do to retrieve your pay stubs, to download your W-2 and um, print it and file taxes appropriately. So we do have until the end of the month to get those out to you guys, but I do know that our director of finance, she's been working on those, getting them back. So just be on the lookout for that. I will say, um, if for some reason it's February and you still feel like you've not received your W-2 or accidentally deleted that email, reach out to me and we'll be sure to get it sent back to you.
Thank you so much. Sorry. Yeah, I have some feuding stray cats that like to steal each other's food. Apologies. But yeah, any questions about W-2s, they'll be going out soon. And then there's an IRS program called VITA. I don't know what the acronym stands for, but it's tax assistance if you make less than like around 70K. So that would, connect you. You can enter in your address and it'll show locations near you where volunteers will be there to help out. For the past like 4 years, I've gotten mine done at Transylvania because they'll have like accounting students volunteer to do it as part of the class. And they're great. So I would really recommend trying to see if there's a free prepare near you. Okay. Other upcoming things, K count is going to be at the end of the month. If you haven't heard, like speak to your supervisor and your site, and if they don't know what's going on, then reach out to me, and I'll connect you with the K count that's happening near you. Oh yes, thank you, Sonia. There's the link for the tax assistance. So yeah, any questions about K count? By the way, that's basically like the annual census of folks that are in shelters or sleeping outside. And so as a part of our program, a part of Homes for All, we ask that members volunteer as a part of that event. We'll be having hours in Frankfort at the HHCK office. So I'll be sending out an invite to members that are nearby. But same with MLK Day, we can talk about that too if you're not sure what's going on near you. And yeah, that is, I think the 28th and 29th, but it's just for like one night. And it's a good experience just to do some outreach and basically engaged. It's very important to collect that data for funding, seriously. And then mid-year evaluations, I'll be sending those out to your supervisor. Your supervisor will leave their feedback, and then I believe it's signed by both the member and supervisor, sent back to us. So those will go out, and that's based on your engagement in the program, at the site. I'm pretty much almost done with our site visits, and those all went really great. So I really appreciate you all welcoming me. I'm going to have those mid-year evaluations sent out by the end of the month, and then they'll be due at the end of February back from your supervisor. development opportunities coming up. I'm almost done. Tomorrow, I'll send this link. The National Housing Resource Center is doing a webinar at 1 p.m. about student debt solutions. I think this is another webinar that's helpful both professionally with our clients and personally. Um, the federal student loans have changed quite a lot. There's new programs that have changed and updated. So I think that's an important one to tune into if you have federal loans. Or if you're, interested in going back to school with your CEGL educational word later, just to understand the terrain. This next webinar will be towards the end of the month. It is sponsored by 988, which I think is the National Crisis Hotline, and it is specifically for those working in the crisis workforce. So if you are often having to deal with crisis intervention or just a lot of that emotional labor that can be quite stressful at times when you're working with clients in very emotionally volatile places at times. It can take a toll. So I'll share that webinar as well, kind of going off of our self-care training, but more specific for members that are often in crisis-like situations with their clients. And then February 21st, this is until next month, but I'll go ahead and send in another reminder when it gets closer. We'll be doing a virtual member roundtable with the State Service Commission. So you may have seen our program officer at orientation. Andy, he'll be there. And it's like a judgment-free, like confidential space to talk about your AmeriCorps experience and your service and how it's been going, and um, to just have that discussion with other AmeriCorps members. It's an opportunity for the State Service Commission to get feedback on programs. But I think it's also helpful to just learn about other programs and how they're doing, how they operate. We're under a very large umbrella in this state. And then lastly, I'll be sending out a service year survey. Service year is an interesting program. It's basically, I don't know even how to describe it. Um, basically they try to encourage open-mindedness and like open discussions and people being able to engage in conversations together that we think may arise in conflict, but they want to teach and discuss strategies to make open conversation easier, more fulfilling, less emotionally charged. So they sent us a survey for you all to complete just about some of your beliefs. If you're able to do that whenever, wherever, and you can log an hour for your time under AmeriCorps training for completing that. I'm looking forward. We had a training with them about some initiatives that they're working on, so I will be like looping back about that, and hopefully we'll be talking about that more. Maybe that'll be an exciting new development opportunity for us to engage with. Um, but yeah, I'll be sending that out, and that is optional. All of these are optional. Um, Reporting reminder, as usual. Volunteer forms, AmeriCorps service and wrap-up forms due today. If you have any questions about these, feel free to ask, but send them however you please to me. To wrap things up, that's all. Thanks again to Rebecca. That's the second time I've seen that presentation, and I still feel like I have learned so much. I know those at orientation as well. It's always just a great refresher to check in with yourself about those things. So to wrap things up, the two upcoming events that members are required to participate in is MLK Day and K Count. We understand things happen, so don't hesitate to reach out to me, and we can talk about it. The intent behind these are that you're able to see a different aspect of service, serve in a different kind of way, to get a fuller picture of the housing landscape. So yeah, that's the intent, if that helps you in determining a project. Tax forms will be delivered soon, electronically. So yeah, check your email, keep an eye on that. Don't pay for tax prep. Your living allowance means that you qualify for free tax assistance, and it's super helpful I'll share development opportunities with registration info in an email after this call. Our next member meeting will be on February 14th. It's Valentine's Day at 2 p.m. We will have a speaker from the Kentucky Secretary of State's office, and he's going to tell us about the new Safe at Home data privacy program. So there is some information that is like public through the Secretary of State's office, but they've created a new program for victims of domestic violence to make this information private. Um, Lastly, submit service forms and timesheets. The last thing I'll say about the Safe at Home, he's just going to give an intro to the program, but also give instruction on how, if you want to become an assistant to help somebody apply to do that, how you can do so. Oh, that's awesome. Sonia said that she already got her Safe at Home training and certificate. Good to hear. Yeah. Awesome. Yeah, you could share your experiences at the next meeting. Um, yes. But even if you're not at a DV shelter specifically, I've heard from many clients um, that they, or not clients, I'm sorry, AmeriCorps members that they just want to feel more confident in like DV type crisis situations and knowing what to do. So this is just another tool to keep in your belt if you ever end up in a situation with somebody dealing with DV. Anyways, any other questions? If not, that is the end. Thanks for staying with us for an hour and a half. I appreciate your patience. Let's see.
Thank you, guys. Have a great rest of your week.
Hi, everybody. Thank you, Whitney. That's so sweet. Thank you all. Have a great week.